There are a lot of myths out there when it comes to car loans, and I feel like way too many of us are falling for them, including myself. And so I just want you guys to be aware that these myths are not true, and that's what this video is going to teach you about. Now, the first myth that I want to talk about sounds good in theory, but it's just not true. And this is the fact that the more you finance, the better off your credit score is going to be. So for instance, if you finance $1,000, it's not as good as if you finance $10,000 as far as your credit score is concerned. Now, it is true that financing a car can help your credit score, assuming that you always make your payments on time, but this is just because of the type of loan that you're using, and it's called an installment loan. And all this means is that you make fixed payments until an end date, so meaning like a 3-year loan, you pay them off for 3 years, and then you're done. That's an installment loan, and those will help your credit score, but it doesn't matter how much you're financing. So if you finance $10,000 or $1,000, as long as you're making those payments, that's what really counts. Because the first time that I bought a car, I was told that I needed to finance as much as possible to help my credit score out because I was a first-time buyer. Now, part of this is true. I did need to finance the car, but I didn't need to finance most of the car. I actually had enough cash to pay off most of it from the beginning, but instead I financed most of it, and that's not what I should have done. I should have financed 10% of the car rather than 90% of the car, because at the end of the day, that would have saved me a lot of money in interest, and I would have had the exact same thing happen to my credit score, which was helping it. So just remember that it's not the amount that you're financing that's going to help your credit score. It's just making those payments on time over a period of time that's going to help your credit score, because that is what they're looking for at the end of the day, is someone who's responsible and can make those payments over a long period of time. Now, the next myth that I want to talk about is that a lot of people think that you can't refinance your car for at least 6 months after you buy it. And this is just not true, because you can actually refinance your car tomorrow if you wanted to. There is nothing holding you back unless your contract actually states that, but I really doubt it. I bet you it's just a salesman, because he knows in 6 months, if you still keep that loan, then he probably gets another kickback. And that's the only reason he's going to tell you to keep the loan for 6 months, unless it's actually stated in the contract. So if you feel like you've got a pretty bad rate on your car loan and that you can get a better one, then I would suggest going to your local credit union, and they can actually check your contract and make sure that everything's okay, because they're not going to be able to refinance the loan unless they pay off that other loan. Now, if you're not really sure if your rate is good or bad, then what I would suggest doing is just find out what your rate is and then compare it to other loans on the market. So just look up your local credit union, find their best auto rates, and compare it to those rates. So for instance, if you have an 11% and the lowest rate that they sell is a 3%, and you feel like your credit score is probably good enough to get you something a little bit better than 11, then I would definitely consider refinancing at that point. Now, the next myth that I want to talk about when it comes to auto loans, and this is the most common myth that I get, and it's just the fact that your payment determines how much you can afford. So for instance, if you can only afford a $500 payment, then that's all that matters. As long as you get a car that's $500 or less per month, then you are good to go. And this is a total myth, because you are going to get totally screwed over when you buy a car, because you're going to finance too much car that you can't really afford. And then you're going to end up going upside down, which means that you actually owe more on the car than what it's worth. And that is always going to be a problem, because you want to have equity in the car. You don't want to have negative equity. Because the last thing you want to have happen is if you go to sell the car and it's actually worth $12,000, but you owe $18,000, then you're negative $6,000 right out the gate on the next car that you're trying to buy. And that's why negative equity is such a problem. And that's why these huge car loans are keeping people in trouble, because they're not paying their cars fast enough as to how much they're actually depreciating at the same time. I mean, honestly, if you give someone a long enough loan, then they're probably going to have a monthly payment that's within reason, and that way they can get into just about any car they want to. But the problem is that the loan is just too long, like what I've been talking about with the depreciation versus how much you're paying off the car. Because if you took on a $40,000 loan at a 3% interest rate, which is actually really good, and you took it for 7 years, which is 84 months, then you'd actually end up with a payment of about $528 a month. And that might sound good on paper, but you've got a very, very big long loan, and you are going to be underwater very quickly. Now, the way that I determine how much car you can afford is actually very simple. All you have to do is make sure that you don't take out a loan for more than 60 months. So 60 months at the most. make sure that you put 20% down on your car. I know that that sucks and you have to save up quite a while to get into the car that you want, but this is the only way that you're going to be able to do it without going underwater in the car. And then after the 20%, you just make sure that your car payment doesn't exceed 10% of your take-home pay. So this is the money that you take home after taxes. As long as it's not over 10%, then you are good to go. Now, the next myth that I want to talk about is a little bit more uncommon, but some people do think that financing through a dealer is going to get you the best rate because they can compare rates compared to a lot of different lenders. And that is true, but there are some twists here that we need to go over. So I'd say that this myth is actually half true because there's a lot of lenders out there that will compare rates and they can get you really good rates throughout the entire country. So for instance, if you found a 3% rate, that was the best you could find locally, then some dealers could actually find you a 2.75 or maybe a 2.5 somewhere else. And that's just a win-win because you're going to end up with the best rate possible. And then they help find you that rate, which is just a good customer service thing. Now, the other half of the problem, this is where we get into the problem here, is that some dealers out there will have what's called a finance reserve. And what this means is that if you get quoted a 6% rate, but that bank in particular was willing to give you a 4.5%, then that gap, that spread of 1.5%, actually goes back to the dealer as what they call the finance reserve, and they get to keep that rate for themselves for the entire term that you keep that loan. So for instance, if they gave you a 10% rate and the real rate that you could have got was a 5%, then they keep that 5% spread all to themselves, and that is just money that they're making and money that you're losing. Now, if you really want to go in as prepared as possible, I would just get pre-qualified from the local credit union. That way you're already good to go and you already have a fixed rate that's been established and it's pre-qualified, so there's no more headache involved. Now, the next myth that some people believe is that manufacturer financing is always the way to go. And this is not always true because if you do see 0% financing for up to 72 months, that might be a very good value, but you might also be giving up something else in return. And that's where you just have to do some basic math, find out what's in the contract, and know for sure if it's a good value or if it's not. Most of the time, the manufacturer is going to have cashback rebates and then they're going to have financing offers, but usually you can't combine the two. So if you take on 0% interest for, let's say, 72 months, then you might give up a cash rebate, and you just need to know how much that cash rebate is in comparison to what you're losing as far as financing goes. So for instance, if you're going to finance a $20,000 car and you could get a 3% rate, or you could actually go with the manufacturer incentive and get 0%, but they're not going to give you that $3,000 cashback rebate, then what you're going to do is just run the different numbers and find out what's going to be better as far as going with a 3% rate and $3,000 or 0%, and then obviously you're giving up the $3,000 cashback. But all of that is going to change depending on the vehicle that you're buying, how much it costs, and then of course what the rebates are, what the interest rates are, everything like that. That's all going to determine whether or not the manufacturer incentives are actually worth it or not. But that is up to you to do the math and to check what's exactly inside the contract just to make sure it's good for you. Now, if you guys want to watch more car buying videos, I'll leave some more over here that you guys can watch. But thank you for watching. If you just found this channel, I'm Jason with Honest Finance, and I make a lot of videos on different topics that'll give your life and your finances more value. So feel free to subscribe if you guys are into that type of content. But once again, thank you for watching. Have a great day.